Hi, it's Matt Sammut with Fortress Financial, and I'm here to talk to you today about negative interest rates. That may sound a little crazy, but that's the way the world's going, and to be honest, the world is a little crazy. Negative interest rates means that if you put your money in the bank, you actually will get less out after the fact. In theory, you're supposed to put your money in a bank, get a little bit of interest, and have a little more after the fact. Well, it's totally getting to the point now where central banks are showing their desperation and they're pushing interest rates into negative territory. It's happening throughout Europe, throughout Japan, and I think it's coming to both Canada and the U.S. as when economies start to shrink, central banks have made it clear they're going to do whatever they have to do to try and stimulate growth. If we really think about it, does it matter if interest rates are at 1, 0, -1? Bottom line is, if there was demand for credit and growth, we'd see it. Lots of reasons why it's not there. We could talk about that for a long time. Things such as demographics with aging societies, people spend less, income inequality where you see the top end really controlling most of the cash flow and wealth. So therefore that leaves the majority to spend less. Confidence that wanes at best. We've come out of a financial major catastrophic period in the 07 to 09. So there's lots and lots of reasons. But what I want to talk to you right now is negative interest rates and how they can be very damaging to society. I wrote down actually 10 points in a blog. Actually, it's what we call Matt's Musings. Come on to the website, have a look at the top link. It's where I do some short thoughts on some really important topics. The blogs, I tend to be more theoretical and have a lot of charts and things. This is one of those where I just started to write on some of the key things that I see as negative interest rates impacting. So the financial system itself is not designed to operate with negative interest rates. It's counterintuitive. I mean, if you really think about it, how can the financial system, firms within it, operate where things are actually negative? It does create a problem, and it's a known fact, and banks throughout the world are scrambling to try and make it work because they know it's coming. They don't want it to work, but they're doing what they can to make it work. It creates a major issue with insurance companies and pension companies. Both have to carry large amounts of fixed income products in pension case to ensure that they can pay out pensions throughout the future. And insurance companies, they got to be careful because they have to protect a certain amount of wealth. That neither can take huge risks with their whole portfolios. Now, when you get interest rates down to 0 or negative, that creates unbelievable pressure for them to make it in other assets. And if they don't, they're going to be severely underfunded. Pensions are currently underfunded pretty much worldwide, and this is going to create further pressures on them to be underfunded that much more, meaning in the future, people are going to have to pay a lot more in because those people who paid in for their lives want that money coming out. We got a challenge ahead of us. Number 3, real rates of return are negative today. What are real rates of return? It's simply the interest rate stated less inflation. So we're running at negative rates. So people's money sitting in fixed income investments is actually losing money year after year, and that's even pre-tax. Generally speaking, it's supposed to at least break even or make a little bit of money for you. It's not the case now, so it's a real problem for people's standard of living and lives moving forward. Number 4, negative rates hurt bank balance sheets. It's simple. Their profit model is much worse with negative interest rates. If they don't make money, and don't get me wrong, banks, I think, in some cases have made way too much money in the good cycle. But if they end up, a lot of the money wasn't necessarily retained within the companies. And when you have a capital structure that I wouldn't say is at risk today, but is potentially at risk in a severe economic contraction, that's not good. So banks' profitability is going to go down in such an environment. It creates an unstable environment for banking where lending rates may end up going up. Sounds somewhat strange. Interest rates go down, yet they push interest rates up. Why? Bottom line is they are profit-driven quarter after quarter after quarter. They're going to do what they have to do to remain profitable. And if that means pushing lending rates up to offset their hits in other areas, they're going to do it. Just as importantly is they may offer less money, more or less credit available, I guess, to the market in general, because when things are risky, they will take less risk. Banks don't like to take a lot of risk, believe it or not. They'll give you money if you're risk-free or if you offer very little risk to them. So that's just how the model works. The next point. With such low rates, companies will continue to invest in capital-intensive technologies. That includes things like robotics, which is becoming huge. It may sound, wow, that's really cool. Companies are now going to be run by robots. It is until your job is displaced and we have fewer and fewer jobs. We know what's happened with the manufacturing sectors. It's disappeared to Far Eastern countries, primarily China. Well, if that trend continues now in other sectors of society where robotics take over, we got a real problem. People need to work. People need to make money. People have to pay their bills. So this isn't an overnight issue, but the more these companies are investing in these type technologies, and they'll do it more and more with interest rates at zero or negative, the longer term structural problems we're going to have. It creates a greater demand for debt, which makes the world vulnerable to rising interest rates. So as interest rates come down, everyone thinks, this is great. I can borrow money and my payments aren't that significant. A lot of people even have interest-only payments, which is dangerous because you're doing nothing to pay down the actual bulk of what you should be. And everyone assumes their lives will continue as it is today. Not always the case. We go through good times and bad times. We live in a leverage period right now, and leverage on the other side of that mountain is painful. And that's what we're concerned about. We've had huge leverage to try and keep things up. Wait till we roll over on the other side of that mountain and these things got to be paid down and economies shrivel. That's a problem. Retired people, they need income. What we've done to them is we've punished them. We've punished their cash flows. And think about it. Even if you're out for 1%, if you got $1 million, that's $10,000 a year. That's taxable. And how can people live on this? So they're going to be encroaching on capital more and more, or taking excessive risks where they probably shouldn't be at this point of their lives. So it's a pretty dangerous phenomena. So we've decided, or the central banks have decided, you're not important. We want people to keep borrowing like crazy, building debt. But you savers, you're not important. It's wrong, it's irresponsible, and you go negative interest rates, you're getting zero or minus on your money. It's very dangerous. We're going to, because of this, probably see a further shift towards risky assets. Well, we write about this all the time, but risky assets today are severely overvalued in a lot of sectors. That's stocks, bonds, and many countries' real estate, especially here in Canada and places like Australia. So when you're in that environment, at some point you will see a correction and potentially a crash in asset prices. For people who are in those sectors and shouldn't be, they're going to pay a monster price, and that just is something society cannot afford to happen. And the last point, the major problem that is being ignored is demographics. I touched upon this, but we live in a society that's aging. What happens when it's aging? Bottom line is people end up wanting less, having less, needing less. The bulk of the money is spent between age 30 and about 45, 50. Now we have the baby boomers who are much older than that, in general, retiring, where their spending habits change. We are a consumer-driven society, and when you are, you're in trouble as far as keeping that trend. So people are wondering why worldwide we're seeing less and less demand. It's a demand problem. Well, this is probably one simple thing that we have to look at and say, we got a problem. You know, there's going to be demand in certain sectors as people need to move into retirement homes. Clearly, sectors like that are going to boom. But there's tons of other consumer areas that will not. And if we can't figure that out in society, we're going to be in trouble. Anyways, bottom line is negative interest rates stink. They don't make sense. They're going to hurt too many players. It's an act of desperation by central banks. And I think we're going there. We can't stop it because, you know, it's like someone who's on a course who just doesn't want to say it didn't work. Quantitative easing at well over $10 trillion worldwide. Interest rates that are brought down to zero, now negative. It's all failed. So they just want to keep trying new things to the point where I think we can be in a very destructive state. Thanks very much, and hopefully this has been interesting for you. Take care.